going to talk about a number of things. In the end, I think you're going to expect us to talk about interest rates, investments, of course, in the various fixed income products, not the PIMCO, but more generally, of course. Want to turn that on?
Yes, turn this one off.
Or I'll just walk away from it, which is easier. I think it'll be good. It'll be good. I'll stay away from it. All right, so I think first I'm going to talk about this short-term outlook. We want to talk about the long-term view, though. There is this view in markets, you see in the pricing, of rates staying low for at least the next 5 years. As you know, markets are priced for the European Central Bank to keep its policy rate negative through 2021. Same for the Bank of Japan, and for the Fed, markets are saying the policy rate will only hit 1% in 2020, despite the Fed saying it'll reach 3. Janet Yellen recently said in a Jackson Hole speech that R star, as it's called by economists, that its neutral rate may not be 3, but 2. She said that August 26th in Jackson Hole. There was an asterisk, though, it was like number 23 or 24 or something like that, where she said, well, it might be 2, this neutral rate. Remember, the neutral rate, of course, is where the Fed's neither putting its foot on the gas or brakes to impact the economy. She said, well, it might be 2, it's probably still 3, because we, the Fed, can let the economy run hot. We can keep the jobless rate low for a period of time and prevent the neutral rate from falling down to 2. So it's probably 3. There's another way of saying something that Ben Bernanke said to us last week and has repeatedly in meetings with him. As part of the investment committee, we get the privilege of talking to him by video whenever we feel like it, or whatever the contract says we can speak to him. And so after Fed meetings or speeches by Janet Yellen, we tend to bring him in. But he says this Fed is still filled with Phillips curve advocates, which is to say, of course, those who believe that stronger growth eventually will lead to higher rates of wage gains and higher rates of inflation. So she still believes that. In fact, he pointed out last week a comment she made in her presser that I'm not the whites of your eyes kind of person, which is to say, she's referring to the expression used commonly about the Fed that it can't wait till it sees the whites of inflation's eyes before acting to raise interest rates, because by then it's too late. That's been the case historically, of course, but there's a feeling now the Fed can wait somewhat. In fact, James Bullard is certainly in the Shogi mindset of the St. Louis Fed. He, as Bernanke says, is basically saying with his dot in the dot plot, the Fed dots, his dot up for one hike and leaving it there. He's basically saying, show me, where's the inflation that you Phillips curve advocates say we're going to get? Because I'm not seeing it. It's part of the reason why the Fed's delaying. So we want to talk about this long-term view on rates that many people have, because it seems very well entrenched, obviously. Here we saw the Bank of Japan last week, extraordinary move to pin the 10-year at 0, which is almost saying it believes its policy rate could stay at 0 at least 5 years, as markets are priced for, but maybe as much as 10 years, because as Bernanke points out, it's kind of dangerous to use the 10-year as the security to put a yield limit on. As he put in his speech over a decade ago, you might recall, was the roadmap for what the Fed has done over the recent years, called deflation. Could it happen here? He, in that speech way back, said he would pin the 2 or 3 year note to 0, and then hopefully would impact the rest of the curve, because with the 10-year horizon, if markets suddenly thought, hey, the Bank of Japan might raise its policy rate in year 3 or 4 or 5, then it could affect the 10-year a lot, because of course long-term rates are cumulative bets on where the short-term rate will be over time. So it's kind of dangerous, you could say, that the Bank of Japan has made this commitment to keep its 10-year at 0, because there is a presumption then that the policy rate will be kept near 0 throughout that time. But that does demonstrate that the Bank of Japan thinks it'll probably keep its policy rate near 0 for a very long time. So we have this view, we, PIMCO, others, markets clearly that the policy rate will be kept near zero for the rest of the decade. So as an investment thesis, it seems almost too easy. It's getting too easy, which is why PIMCO is recommending to dial down risk a little bit, just to be somewhat cautious now, given that valuations are full. The investment thesis has been, but it's getting a little shakier. To simply move out along the risk spectrum and buy everything. Just choose beta on equity risk and also credit risk and also on real assets. But beta risk is getting more dicey, and one has to be patient and prudent about investments he or she is making, of course, and just realize you're filling me. So is my moving around a pain? Would you rather?
Nope, it's fine.
You'd probably rather I stay there. So you
No, you're fine. It's fine. It's absolutely fine.
Sorry.
It's good.
I forgot about that. You have to be a professional accounting person. Anyway, so let me start with the secular themes and then go back to short-term stuff later, because it's this overriding secular theme that is dominating markets right now, this idea that rates will stay low and pushing investors to take risk. So why is it that policy rates will stay low? You have to name, well, there's 5 reasons I tend to cite, and I relate these to 5 the Fed cited in March 2014 in the minutes to its FOMC meeting back then. There's one that stands out the most for now, and it could have implications for next year. That could turn everything upside down. You could actually have a scenario where rates are higher, which I'll describe in a minute. Let me go through the 5. And this builds the case for rates staying near zero globally for years. Number one, this idea that consumers won't be spending in the ways they used to. Seems to make sense. Many were out of a job for a long time, and many took a long time to get their jobs back. And the duration of unemployment is still high by Yellen standards, and that doesn't exactly put people in a spending mood. Of course, income growth has been slow, and there is the shock of the financial crisis. People remember things like that. Certainly, it's nothing like the Great Depression, but it's well known that for a generation after the Great Depression, behaviors changed. So to some extent, there'll be a change in behaviors now in terms of how people spend money. A little less ostentatiousness, more frugality. That's what we've been witnessing, and so we should expect that. There's no reason to believe right now that households will be in a spending mood. They're spending better. It's not bad. Household spending in the last 2 years, based on the PCE data within GDP, has grown at a 3.2% pace compared to a 1.9% pace the 2 years prior to that. Part of that's oil. People say consumers aren't spending the windfall, but it's not true. We have a 1.9% figure for the 2 years prior to oil falling, 3.2 after. So there is some money being spent. It's just not robust. It's decent. But household spending staying somewhat subdued is one of the 5 reasons to think economies won't grow as fast as they used to, and the Fed, therefore, will keep its policy rate low. Second thing relates to the global story on aggregate spending. The inverse of that is the global savings imbalance. Does anyone believe that the Chinese consumer, for example, will suddenly open up his or her pocketbook or wallet, whatever? No, because what's needed there, as you know, first, growth is slowing, so there isn't the same. They're optimistic. Chinese citizens tend to be, in all the data, very optimistic people, and they should be. There's a lot to be proud of. Just look at pictures of Shanghai today versus 25 years ago. It's unbelievable. It's astonishing what's happened. They have every right to feel very confident about moving forward like America did, let's say. When? 100 years ago, Reagan years, choose your period. Jimmy Carter days, whatever. Maybe not. Some of you too young to remember that. But what they're faced with is a lack of a social safety net. And this won't change in the next 5 years. In other words, in a lifetime, a Chinese citizen receives about $1,500. In a lifetime. Many Americans get that amount in a month, or in a couple weeks, in some cases. And so faced with the lack of a social safety net, Chinese households are apt to save and not spend. In other words, keep the savings rate close to 50%, very high. That's difficult to change. And so one thing to think about for 2017 is China and changes in power Xi Jinping, as the president, of course, has been in place 4 years. There's a big change in power in the Congress next year, and also the Standing Committee, which is a body of 7 people, which includes Xi Jinping, Premier Li Keqiang, if I'm pronouncing it correctly, and 5 other members. Xi was really smart 4 years ago. When he put them in these 4 members in place, it's a very powerful body, this Politburo. They were all age 65, and there's a mandatory retirement age of 70, so he knew they'd be out. So he could say, you know what, you guys are gone. I'm going to put in people that are better than you, or that are more aligned to me if you ever deviated. So that's a big change next year, and plus 1,000 people within the Congress, something like that. Big turnover. There's a big battle right now, in fact, between the Premier Li and President Xi as to the direction China will take. Xi wants it to be less debt-driven. Xi wants it to be more high quality rather than quantity of growth. Doesn't want to take the easy road out. So a lot's going to happen next year. It's going to be a big deal. Look for growth in China to be stable around 6%. Don't worry about the NPL thing, by the way, too much. They're going to recognize loan losses probably slowly. It's currently 1.5%. It'll probably grow up to 5-6% over 4 years or so. That's what our projection is. There's not going to be any big banking issue to our way of thinking. No big China issues now, but something important, again, next year, the power changes, but not enough to change the global savings and balance, the global spending story, and the neutral rate story, that it stays low. And if I didn't say it, PIMCO's view on the neutral rate is 2. The nominal rate is 2. Inflation is at 2, so that means the real rate is 0. We think neutral eventually will be around 2 or so. Again, the Fed's around 3. So his third reason is demographics. Not much to say on it except to point out the obvious, that aging populations, all the data show, grow more slowly than nations that have younger populations. It's just fact, difficult to refute. I'm not going to say much about it. And that's embedded and entrenched because, of course, America has an aging population, median age of 38, roughly, rising into the 40s, into the 2020s, because baby boomers, those born between 46 and 64, began turning 65 in 2011. And there's a major number of people. There's 35 million people aged 55 to 64, by the way. So demographic stuff is all entrenched and embedded, will be affecting the economy negatively through 2029. All right, fourth is credit growth. And this, in fact, it's a major story, and it answers the question, why are central banks hell-bent on printing money? It's because they've been worried about the rapid pace of bank deleveraging. In the end, the most important thing central banks have done since 2008 is slow the shrinkage of banks, especially in Europe, because they're overbanked. As one BCB member said yesterday, it's too large, the banking system. 3 times the size of GDP versus 1 to 1 here. If banks shrink faster, money in a fractional reserve, fiat-based paper system, money disappears from the financial system, like it did from 1929 to 33. Milton Friedman, over a decade ago, before he passed away, in an interview said, and I'll cite him because it's hard to get these data verified, but he said it, I'll believe it. He's like a money god. He said that the money supply in America from 29 to 33 shrank 33%, hence the depression. If you believe that money matters, and you should, it's a fractional reserve banking system where banks create money out of thin air, then that stuff matters. If there's fewer dollars, euros, yen in the system, there's smaller amounts of money to spend, and hence you have weakness in demand, prices, et cetera, et cetera. So central banks have been trying to fight that. And here's how it goes, though. And so credit growth is slow. In Europe, credit growth in the last year is 1.5%. It had been negative for 3 years straight. It used to grow 8% the last 20 years, 8% or so. America's slow is right now too, but faster than the rest of the world. But at least it's growing. So they've been successful in slowing this down. So here's how it goes when in a deleveraging process, and why it is that it's so important. First, here's how money creation begins. It's simple. Fed puts $1 in the system, bank lends it, let's say to you, you spend it, the entity person puts it in his or her or its bank, that bank then re-lends it, You can only lend out 90% of it because it has to put 10 cents aside, 10% of it aside as a reserve requirement. So it makes a 90-cent loan. It's brand new money. It's money creation. The next bank that gets it after that whole process occurs again will lend out 81 cents, and the next bank 72 cents. And that's how $8 can be created out of one. This is why capital ratios you always often hear around 12%. They're low. It's highly leveraged, the banking system. So that's how money creation happens, how indebtedness happens. It's what happened for decades. But picture it going in reverse. What if you decide you don't want this stuff anymore? That factory, the bank, created the stuff. You say, take it back, I don't want it. You repay the loan, call it $1,000, repay a $1,000 loan through physical currency or transferring from your checking account. Either case, it eliminates that money, extinguishes it, it vanishes from the financial system. It can no longer be spent in the system unless the bank does what it customarily does, and things are operating well, replaces your loan with another one, and then another, and some other one that keeps the growth going. Money vanishes from the system. It's a very big danger to the financial system to have that condition. Van Bernanke understood it. He had studied the Great Depression, and hence he printed money like mad, and so did Draghi, and of course Kuroda in a very big way. It's that high indebtedness. And so that was a really big deal. So it's a long way of saying the credit story is important, and it's been weak and threatens the financial system. So central banks have to keep rates low and accommodative to prevent the faster rate of bank deleveraging and the vanishing of money. And the fifth reason relates to things that are important in the short run as well in America after the election. It's productivity, which is part of the GDP potential idea. So the Fed in its minutes said one reason why we need to keep rates low is growth potential has gone down. Growth potential, of course, is labor force growth plus productivity. Labor force growth historically is about 1% in America. Productivity has been 2%, so hence the old 3% growth we used to have. These days, because of the aging of the population, labor force growth is called at 0.6% per month. Productivity the last 5 years is only a half point. A half point. It used to be 2, just a half point. So why is it first that it's moving so slowly, productivity? It's easy to see in the data from the Bureau of Labor Statistics. The 3 sources of productivity is people, called human capital, stuff, it's capital equipment, software, structures, infrastructure, things, usually physical, now software. And then third, how it all gets used. That's TFP, total factor productivity. In the data, the biggest source of weakness, first time since, well, the only chart I have goes back to 1953, but from what I've read, it's maybe the first time or only second since the Depression that capital investment has shrunk. Now, capital spending goes up. You see it in durable goods reports like today. It's been rising, capital spending, but as a proportion of job growth, it's not. So let me change that description. It's the phrase they use is capital intensity. How much capital is in place? How much stuff is in place per unit of labor? That's what matters in the end. So picture a company 5 years ago that had 100 people, 50 computers. Today, of course, they have more people because they've been hiring, but for simplicity, keep that fixed. It's still 100 people, but 48 computers. Now, assuming, because there's been a decline, a rare decline in the amount of capital in place per unit of labor. Assuming more computers is good for productivity, then what's happened recently is bad for productivity and bad for growth, and therefore a reason the Fed need to keep rates low. Now, here's where there's a chance for change. Now, I mentioned those other forces, household spending, global spending, demographics, and credit. Those are not likely to be impulses that change much next year, unless the consumer suddenly feels better about things, like yesterday saw in the Consumer Confidence Survey, the best since 2007. Maybe things will turn out well, finally have more active Congress and things go better. Now, Janet Yellen, here's the 2 important things she said, and it's also in a write-up we have. This isn't a promotion, but just to give you more color, if you want to read more. We wrote an article, people within our organization, after our cyclical forum, on on our cyclical forum, describing how productivity could affect markets. So I can just give it quickly. She said in August 26th in her speech, the last paragraph of her speech before the conclusion, she said, first she said, we should all endeavor as a nation to do this and that to boost productivity. It's not in my purview, she said. Maybe we should have more R&D, things like that, more investments, this sort of thing. But then she said, higher rates of productivity would lead to a higher average level of market interest rates. Higher level of interest rates. Actually, you say market. And then in July before that, she was asked by a congressman when she delivered her semi-annual monetary policy report to Congress, what would happen to Fed policy if productivity were to increase faster. She said the neutral rate would rise. The reason, of course, if there's more productivity, there's more earnings for companies, more earnings for people, more spending. Since it's a set level of capacity, it would boost the average level of prices of goods and services and hence require the Fed to be more vigilant about raising interest rates. So it's really important. So for 2017, the investment outlook, you have to be thinking about whether America is pivoting toward a little more fiscal spending. In fact, we expect some increase in fiscal spending, but not a lot. So both sides of the aisle have proposals to increase infrastructure spending. Hillary Clinton's number is about 300. Trump's number is really big. That's what he says. It's really big. I don't know what the number is, but it's a number. It's a number. So positive. So there's probably going to be some pivot, but they're both limited by the lack of a filibuster majority in the Senate. So we're not expecting any big stuff to happen. As you know, the split in the Senate now is 54-46 Republicans, Democrats. 34 of those seats are up for grabs in this election. 24 of them Republicans. So the odds of Republicans having 60 seats is low. And of course, the Democrats at 46, while the hurdle is a little lower, getting to get a majority at least, to get to 60 is a high hurdle. So it's highly improbable that whoever is in power will have enough power to push whatever he or she wants through. And so the amount of pivot stimulus will probably be a little light. So in other words, productivity won't increase meaningfully. And plus, when it happens, it won't really hit the tape until after the new fiscal year begins, October 1st. And so in markets, though, we're probably pricing in a little bit before. So PIMCO's calling for 2 rate hikes next year, in part because of this pivot idea. Markets are priced for 1, so it's double the amount. Woohoo! But can't get excited, you know. These rate changes are so tiny. Can't forget the 80s. I was alive. It's in the markets. I started to work on Wall Street in '83. 94 was a big one, a few 25 basis point hikes, then a couple of 50s, then a 75 basis point move, an 8% 10-year. So while we speak to the idea of more than the markets are saying, one shouldn't be fearful. One has to, when focusing on Fed policy and monetary policy globally, not get caught up in this short-term itis and stick with the long-term view that the ECB's policy rate, the Bank of Japan's policy rate, and the Fed's will likely be lower than normal for a long time. And what you need, though, for your investment thesis to own equities, have equity beta, credit beta, and also some exposure to real assets is you need continuous economic growth, cash flow. That's the name of the game in the end. For profits, for dividends, to make your interest payments, to pay you back. And so you have to keep betting on that. And we are. We're not seeing a reason for recession to shift. All right, any questions about any of that before I ramble more than I have and should? Any questions about that? I'm catching you off guard. Any questions, comments? Yes, sir.
You had mentioned earlier how money is created.
Yeah.
One of the things that jumps out at us is the Fed's obviously printed all this money. And when we look at like bank reserves held with the Fed, historically they've been like 105% of required reserves. And now they're like many, many multiples. I forget the exact number. I mean, is there something, I mean, are all these 5 secular points that you've made part of the reason why that money is not making it into the system? Is there something else that's broken on the velocity function
Yeah, so we're looking at reserves in here, down there, and is there something keeping, maybe including these 5 reasons that I mentioned, from that money from entering the system, and maybe causing or helping growth along and inflation? Well, there are many forces, for sure, yeah, all of these things, because if there was more demand for money, then there would probably be a bit more lending. We know that companies aren't as interested in borrowing to expand. They simply don't want to expand. People aren't as interested either. You've seen the debt-to-income levels come down nicely since 2008. It was too high. 6 years ago, 6.5, I wrote an article called, in fact, I was reworking it this week, because I'm writing a book on the Fed. The 6th book, by the way. It's been a long time since the last one. It's been too busy. 5 years. I was supposed to do a book a year, my own mind. And I've been not done nothing for 5 years. So lazy. Really. Anyway, this article is called Yucca Mountain. Because I thought of the idea that, so when I wrote this article around 2010, Greenspan was in advisor at PIMCO. Yellen is probably a future advisor, I'm thinking, the way things are moving. Former Fed chairs wind up with us. Also Trichet from the ECB is an advisor at PIMCO. They have good insights. I'll give you a few of those in a second. But anyway, he would walk into our office, and I saw the paper the other day that I kept from him. He said that because of the increase in reserves, that inflation would reach double digits. He predicted to us that inflation would reach double digits. We never really signed on to that idea. But he presumed that the old relationship between reserves and lending would continue, at least to some extent. But it hasn't. So the Fed's a Yucca Mountain in the sense that it stores toxins. As you know, in Yucca Mountain, they actually don't store toxins. They were supposed to until environmentalists stopped them. But it's supposed to store nuclear waste, but never did. But so the Fed is a Yucca Mountain in that it stores inflation toxins, all these reserves. And the only way that there can be inflation is if toxins seep out. The banks simply don't want to lend. They're being pressured to just watch the news. Regulators are on their backs, and they want to stay ahead of regulators. They're still not sure of final rulings on various elements of Frank Dodd, or is it Dodd-Frank? And so they worry, and it keeps them from lending. They simply had a bad experience in 2008, and they're not likely to repeat it. What they're trying to do is build up more total loss absorbing capacity, TLAC. Actually, in fact, they'll issue bonds to bring up their TLAC, TLAC eligible bonds that they issue frequently to bring the amount of capital that they have in place higher so they can absorb losses. Because regulators are telling them, we didn't like what we had to do last time, we didn't like having to bail you out. So we want you to do various things to make the investor get hit, and for you, the investors, of course, would be those investing in equities or AT1 bonds and that sort of thing. So that's so many reasons, and but that is a crucial element in this whole story, the credit portion, but it does relate to the other 4 reasons I gave. Any other questions or comments about anything? No? All right, just quick on near-term policy. So I've described the long-term view on rates in part to distract you from the short-term stuff, which is because as a long-term investor, you should not pay too much attention to the short-term stuff, but we just quickly say it does look highly probable that the Fed will be raising interest rates in December, provided payroll growth is around 150,000 per month. By exponentially, what's the number? Yellen, in her presser last week, said 180,000 a month is unsustainable. This is despite the fact that payroll growth for 3 years has averaged 220 a month. Here she is saying a lower number can't be sustained because she knows, this is based on the Fed's own models, that payroll growth is apt to slow when the economy reaches full employment. The Fed's own model, the FRB/US econometric model, projects payroll growth to slow this December through 2020 to under or around 100,000 a month. 100,000 a month. So you're going to get used to optically seeing much slower job growth numbers. The reason why 150 is still enough is because, and this is that bar we would say, the near 150-ish. There's a qualifier though. It's because labor force growth has been 80,000 a month. 80 the last 3 years. So if it's 150 a month, 70 over labor force growth times 12 months, 840 a year, enough to lower the jobs rate 0.5 of a point a year. presuming the labor force grows 80 a year. Now, Yellen and Bernanke put an emphasis on this last week. She said the economy has more room to run because the labor force growth had picked up. So that 150 a month, 180 actually for the year, 182, that 182 per month this year has been met by labor force growth of something similar. So the jobs rate hasn't moved. It's come down a touch, but it's barely moved, unlike the prior 4 years, down a point per year. So he says the way out, the only way out for Yellen now is if the composition of that 150 a month is skewed toward high amounts of labor force growth. If there's a lot of labor force growth and the jobs rate holds steady, she might have an excuse to say, you know what, we don't want to move. But she's getting a lot of pressure, and there's something really intriguing for Fed watchers on this. First, 8 of 12 reserve banks in July requested a hike in the discount rate. Now, Bernanke has said to us that that matters because 90% of the time the requests by the reserve banks reflect the views of the FOMC president. So 8 of 12 said, we want a hike. Now, there's one other person that could, of the 4 remaining, that could change his mind. Actually, I'm saying the wrong thing on that. There is one, but that's another different point. But I wanted to mention the idea that there's one person that has a lot of power right now, because there were 3 dissents last week, and it's James Bullard. So I'm going to watch. I think he speaks today, or is it tomorrow? Sorry. But anyway, he matters because his bank in July requested a hike, but he hasn't dissented in favor of a hike. What if he decided, he's someone who has seemed to want attention now and then, what if he decided, I want some attention for my idea of a hike? He could be the 4th dissent, which is like mutiny at the Fed to have 4 dissenters. It's like late 70s under Carter. There was a Fed chair that was only in place for like a year and a half. It was not as well liked. His policies, many thought were terrible. It was high dissent, very open too. What if he decided then, Bullard, I want a dissent, I want a hike here in November? That would be a lot of pressure. We don't expect it for November. We're in the December camp. But if he wants to hike and says, I'm going to formally dissent, this idea that Yellen is moving against the grain of her colleagues probably wouldn't play well, because you want to see a consensus at the Fed. So that puts a lot of pressure on her to act. And as Bernanke said to us, the Fed is heavily leaning toward a hike. All it needs is the 150 a month, 2% growth in GDP, no major disruptions globally, and you're going to get a hike. So that's the near-term stuff. Against the boring when you think about the long-term picture. Any questions about near-term Fed stuff? Anything like that? But one other quick thing to say about it. All of the actions the Fed's taken lately, its dot plot, its projections, its lowering of what it thinks R star is 2.9% now, lowering of 4 out of 5 SEPs, mean its purchases, its holdings of mortgage-backed securities will be kept longer. As Bernanke put it to us, the timeline means at least 2018 before it tapers the reinvestments of its principal payments in mortgages. It's really important to the bond market and then hence the stock market, because the Fed holds $1.7 trillion of mortgages, many mortgages that maybe you have. The Fed holds. When you make a mortgage payment, the Fed says, thanks very much for making your payment. We're going to take it and invest it in a new mortgage, one that was just created last month or next month through the TBA market. And so that keeps its holdings constant at $1.7 trillion. It's 30 billion of those mortgage payments a month the Fed takes and puts in a new mortgage. When the Fed decides to taper, it'll say, well, thanks very much for your payment, and that's it. It won't purchase any new ones. So its 1.7 trillion holdings will go down 30 billion a month at some point. But the fact that it's going to hold these, since the yields on mortgages are about 90 over treasuries, or swap rates, I should say, they're a good play for us. We're slightly overweight agency mortgage-backed securities simply because the Fed is keeping them higher priced than they probably otherwise be, and there's no threat of tapering from the Fed and disruption then to the mortgage market. So that's one investment idea. More broadly on investments, just quickly run through risk factors. I'm running out of time, I see. Duration, it just depends. If you have a portfolio laden with credit and equity risk, you want a little bit more interest rate risk. And we would take it on the, believe it or not, long end of the yield curve, because it's higher, what do you call it, the word, convexity, positive convexity. In other words, if things go terribly in the world, where is the world going to go, since there's 10 trillion of negative yielding bonds? To the long end of the U.S. yield curve. Short end doesn't provide the juice, because it's got a limit how far yields will go down because of the Fed holding rates, either holding rates steady or maybe even raising rates. If things go well in the economy, while you might think that this is bad for the long end of the curve, probably not. It's worse, but it's probably true, but worse than short end, because then the Fed will be raising rates to fight inflation. So there's high convexity on the long end. So duration depends. If you've got a lot of credit and equity risk, it's okay to have a lot of interest rate sensitivity to guard you against the risks in your portfolio. But for more balanced portfolios would be slightly underweight, certainly for Germany and for Japan, and we keep our duration in the United States, touch of Mexico, perhaps. Curve I just spoke to. Volatility in options markets pricings are very, very low, so we'd be very cautious about taking volatility risks. Those come in different forms, but we play a lot of options markets, and we're cautious about adding theta, meaning selling strangles on the 10 years, selling options against credit, iTrax, CDX. Be cautious about that, just be patient. On credit, we're overweight as a general investment thing, but it depends on, again, the makeup of a portfolio and where we're getting the credit from. We like investment grade bonds, yielding nice premiums over what's normal for a time when the economy is growing at a sluggish pace, sluggish enough to keep the Fed on the sidelines, which is good for credit instruments. So we like investment grade, we like high yield, especially short dated ones. This morning I bought, so I can manage some total return style portfolios, but I think it was a 1 year maturity for 3%, which is higher than the Barclays aggregate is yielding, around 2, and it's self-liquidating. So if things don't go well in the credit markets, high yield market has a hiccup, well, slowly but surely these securities would go away. So you want some self-liquidating aspects to it. We like bank capital a good deal, yielding near 8% or so in Europe. These banks, they're not liquid, it's not a liquid area, like sort of like high yield, but very high yields relative to the credit risk we think you're taking, because the European Central Bank is supporting the banks,